The Bogleheads Guide to Investing Part 2, The Silent Millionaire Secret of Compounding. In Part 1, we saw that financial freedom begins not with the stock market, but with lifestyle. The borrower mortgages the future for today's shine, the consumer merely gets through the months, and the keeper quietly saves a portion of their income for the future. Right there, the story paused on an unfinished question. If someone has started saving, controlled debt, and built an emergency fund, then what is the real game now? Should money just lie in the bank or be put to work? Now imagine a quiet dinner going on in Florida. One evening in 2005, a few Bogleheads are sitting, and Jack Bogle suddenly tells the story of a letter. Hidden in that letter was an investor who had never earned more than $25,000 a year. But when his portfolio was looked at, the number was shocking. Around $1,250,000. That is, wealth even more than $1 million. Now the question was the same one that comes to every new investor's mind. How did this happen? Had he caught some secret stock? Had he won a lottery? Had he received a large inheritance from some family? Or is there a simple rule like this in the world of investing that people ignore, thinking it is boring? Right here, the mystery of Part 2 begins. Part 1 explained that becoming a keeper is necessary, but Part 2 explains that if a keeper's money gets joined with time, then an ordinary income can also give an extraordinary result. The scariest thing is that most people look for a miracle to become rich. They get stuck in the thinking of lotteries, tips, fast returns and jackpots, but the real miracle runs very slowly. The name of that miracle is compounding. From the outside, it looks like just math, but from the inside, it is a machine of time, patience and discipline that quietly builds wealth. Compounding does not mean just earning return upon return. It means that after a point your money does not work alone. Its old growth also starts giving birth to new growth. Like a small snowball rolls down from a hill. In the beginning, it looks small, but with every turn more snow keeps freezing onto it. Time increases, size changes, and then suddenly the result starts becoming visible. The same thing happens in investment too. In the first year, growth feels modest. In the second year too, nothing special is visible. But years later, that same small money starts taking a large shape, and people ask, how did this happen suddenly? The truth is that compounding does not happen suddenly. It remains invisible for years. Then one day its result looks so big that people consider it luck. This was the real strength of that Florida letter. That investor had not seen a big salary package. He had just invested regularly and let time remain on his side. Many people whose income is around $25,000 think that to become a millionaire they need something dramatic. But the Bogleheads philosophy says that you need discipline, not drama. The dream of a lottery is very attractive because hard work is not visible in it. But its probability is so low that making a life plan on it becomes a fantasy, not financial planning. Investment feels boring because there is no explosion in it today. But this very boring path often turns out to be the most powerful, because behavior works in it more than luck. Now a simple tool comes here, the rule of 72. This is not a magical formula, but a quick way to understand in how many years your money can double. If the average annual return of an investment is 8%, then divide 72 by 8. The answer will come out to 9. That is, in approximately 9 years money can double. Now this sounds small to hear. But if that same money doubles in 9 years, then doubles again in the next 9 years, then doubles again after that, then the story starts changing. Right from here, the power of time becomes visible. A young investor might have less money, but has more time. And for compounding, time can be even more precious than a big salary. If someone starts at the age of 25, they get decades. But the one who wakes up at 45 needs more saving, more pressure, and more emotional discipline for the same result. This is the reason that start early is not just advice, it is a warning. Starting late is not impossible, but the cost of delay is invisible, and that very thing is the most dangerous. Every year that you do not invest is not just a missed saving of 1 year. It also misses the compounding growth of many future years. The pattern interrupt is right here. People ask, how much should I invest? But before that, the question should be, how fast can I start? The simple secret of the Bogleheads is, spend less than your earnings, save and invest regularly. This is so basic that people do not even take it seriously. But in finance, many times the most basic rule is the hardest. Because fighting the market feels easy, fighting one's lifestyle feels difficult. In Part 1, the keeper saved at least 10% of his income. Part 2 says that he does not just save and keep that 10%, he invests it for future growth. This 10% is not an exact rule for every person, but a starting mindset. Meaning, pay your future first, then give payment to the world. When the salary arrives, bills, shopping, subscriptions and lifestyle attack instantly. If saving has to be done later, then often nothing remains. Therefore, the smart investor takes out saving first. But taking out savings is not enough either. If money is kept for a long-term goal, it will have to be put into such assets that can grow with time. Now a new fear comes here. Where to invest? Stocks? Bonds? Mutual funds? Treasury issues? Annuities? Words feel so complex that the beginner feels happy just looking at the bank balance again. But Bogleheads say, investing feels scary when you do not know what you are buying. Therefore, the next rule is, know what you're buying. A stock is not a lottery ticket. A stock is a small ownership share of a company. When you buy a stock, you are buying a tiny piece of a business, not a price chart. If the company grows, earns profit, and the market values it, the stock price can increase. But if the business struggles, the stock can fall too. This is the reason that there is both reward and risk in a stock. There is the possibility of growth in it, but also volatility. Today price up, tomorrow down, and the day after tomorrow something else again. The beginner's mistake is that he considers the stock merely a ticker symbol. But in reality, behind every ticker there are employees, customers, products, competition and management decisions. Now the world of bonds is different. When you buy a bond, you are not buying ownership. You are lending money to the issuer. The issuer can be a government, a corporation or an agency. In return, it promises to give you interest and return the principal upon maturity. In a stock, you are like an owner. In a bond, you are like a lender. Stock is a story of growth. A bond can be a story of income and stability. But here too, blind trust is not right. Every bond is not equally safe. The risk of a government treasury bond and a weak company's risky bond can both be different. US treasury bonds are often considered the safest because they are backed by the credit of the US government. But safe does not mean that return will always be high. Now mutual funds come. You can understand a mutual fund as a basket of investments. In this, the money of many investors is combined, and then it is invested in stocks, bonds or other securities. For a beginner, a mutual fund can be helpful because he does not need to choose every individual stock himself. He gets a ready-made basket. But here too there is a hidden fork. Mutual funds appear in two broad styles, active management and indexing. And this very fork can make a huge difference in the future. The active manager tries to choose the best stocks or bonds and give higher returns than the benchmark. He says, I can do better than the market. The index fund says, I will not try to beat the market. I will closely follow the market or benchmark, like an index of large companies like the S&P 500. At first glance, active management feels more exciting. An expert is sitting, doing research, choosing winners. Hearing this sounds logical too. But in investing, the thing that feels exciting is not always the best. Many times simplicity, low cost and consistency are more powerful than flashy promises. This point will not open completely right now, because in part 3 this big question will come up. Should the average investor try to beat the market, or is moving with the market more sensible? For now, understand this much, that while buying a mutual fund, one should not look merely at the name of the fund. What is inside it, how much the cost is, what the strategy is and how the risk is, all of this matters. Now come annuities. An annuity is an insurance contract in which by paying money, an income stream can be received in the future, many times in the form of a lifetime income. This can be useful in retirement planning, but it is not a simple product. In this, understanding fees, terms and conditions is very necessary. The broader message of Bogleheads is this very thing: understand its nature before buying any investment. Is it ownership, a loan, a basket or an insurance contract? If you do not know what you are buying, every up and down of the market will scare you. Knowledge is necessary not just to increase returns but also to reduce panic. There is an emotional truth here. The beginner often is not afraid of risk, he is afraid of confusion. When he does not understand how the thing works, even a small fall feels like a disaster. But as soon as the investor knows that stock is ownership, bond is lending, mutual fund is a basket, and index is a tracking system, fear starts getting a bit structured. Structured fear is manageable. Unclear fear is dangerous. Because in unclear fear, people sell at the wrong time, buy the wrong product and get carried away by others' voices. The power of start early and invest regularly connects with this very knowledge. If you do regular investing, the ups and downs of the market become part of your journey, not an enemy. Investing a small amount every month might feel boring, But this habit reduces the pressure of market timing. You do not wait for the perfect moment, you follow a process. The biggest loss of many investors happens not from a bad investment but from delay. They keep learning for years, keep comparing, keep being afraid, and the compounding clock keeps ticking. The meaning of this is not to put money without understanding. The meaning is to take basic understanding, start early, and then make learning a part of the journey. You can save by buying second-hand things, reduce restaurant spending, choose low-cost living, postpone unnecessary luxury. But the goal of all of this is not just reduction. The goal is freedom. Every saved dollar or rupee can work for you in the future. Reducing spending is not punishment, it is giving fuel to compounding. The keeper of Part 1 now starts becoming an investor in Part 2. Moving away from show-off, he starts understanding the language of ownership, lending, funds, and long-term systems. But still, a big decision stands in front of him. When options are so many, how to make the right mix? How much stock, how much bond, which fund, how much risk? Right here, investing becomes personal. A young investor can bear more growth, a retired person wants more stability. Someone's goals are short-term, someone's are decades away. Therefore, a copy-paste strategy in investing can be dangerous. What is right for your friend can be wrong for you because time horizon, risk tolerance, and goals are different. But the universal truth remains the same. Start early. Invest regularly. Understand your things. Pay attention to cost. And do not let market noise become bigger than your life plan. The story of that dinner in Florida is powerful because it proved that wealth is not merely the property of high income. Wealth can also go to those people who pay the rent of patience. The story of becoming a millionaire was built there not from a lottery but from repeated deposits. Not from a jackpot but from decades. Not from a flashy prediction but from quiet discipline. And this is Part 2's satisfying payoff. Compounding is not a secret door, it is an open door. But only he goes inside who starts early and walks without stopping on the path. Still, a mystery remains even now. If compounding is so powerful, then why do so many investors lag behind even average results? Is the problem that they do not invest, or is the problem that they invest in the wrong way? Can active managers really beat the market, or is this promise not as simple as it sounds? In Part 3, the story will go to this exact turn. There we will see why the quietest strategy in the crowd of investing sometimes turns out to be the strongest, and why beating the market becomes the most expensive dream for many investors.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.